Good morning, everyone. Thank you for joining us for this week's instalment of Trending Treasury for a discussion around credit markets. We will take a look at what has changed over the last year, including the major updates, alongside what we can expect going forward. My name is Henry Johnston, a Senior Client Executive here at Arling Close, and I'm joined by a colleague who is very well placed to discuss this topic, and that is David Green, a Strategic Director here, and who is also the head of Arling Close's credit team. So, David, a warm welcome to you. How is sunny Suffolk treating you this morning?
Thanks, Henry. It's very good, actually. My only complaint is that with all this rain and all this sun, the grass is growing. And I need to cut it twice a week at the minute, which is shocking.
That's true, but good weather is definitely appreciated in this country. So kicking things off, let's think a little bit about credit risk. Why is that so important to local authorities, David?
Well, clearly, I guess it's one of the biggest risks. It's credit risk is the risk of, lending money to someone and then not paying it back to you. And it's one of those things, it happens very rarely, does it go wrong? But when it does happen, it goes wrong in a really big way. It's the sort of thing you might lose millions of pounds, but only once every 20 years. So it's difficult to really sort of plan for that, difficult to budget for it. You'd much rather lose a 20th of the amount every year, because you could put it in the budget. So it's one of those things that, if you're not careful, can really jump up on you. And you can't insure against it easily. Something similar might be like your house catching fire, or the council offices catching fire. I'm sure most councils have got an insurance policy to cover fire insurance. Again, something that could cost millions of pounds might happen once every decade or couple of decades. So given that we can't insure against it, it's something we need to protect against and take great steps that it doesn't affect us. And that's the key.
Okay. And how would you then potentially manage that? Have local authorities defaulted in the past? How would they look to manage that?
Yeah, I mean, we've clearly there have been problems in the past. BCCI was in the 1980s, the Bank of Credit and Commerce International, and that was at a time when the central government gave local authorities a list of banks they were allowed to lend to, and BCCI was on the list, but it still went bust, it still defaulted. And there was one council in Scotland had pretty much 100% of its investments at a single bank. And that was one of the drivers of the SIPFA Code of Practice on Treasury Management being introduced. I guess fast forward 17 years, took you to 2008 and Icelandic banks defaulting. Again, affected a large number of local authorities. Okay, there were several banks defaulting, but one council in Surrey had over a third of its money in those banks. Still a significant proportion of its investments at risk. So I guess part of the thing we do is try and bring counterparty limits in. So that's one of the key ways of managing risk, is to have a limit, so that no one plans to lend to a bank that's going to default, but if it does, at least you've got a small amount of cash deposited there. It's one of the key management tools. The other tool, of course, is to be careful who you lend to. And this has changed recently with the rules on bail-in. So we're less likely to see banks put into insolvency. We're more likely to see them bailed in now. And that's where the bank thing says we can't shut the banks. We've got to keep them running. But equally, the government says we can't have a taxpayer bailout, like we did in 2008 for some of the big UK banks. So the bail-in is where the large investors in the bank take a haircut on their investments to protect the retail and the small investors. And the trouble is, if you're a local authority, then you're classed as a large investor. You're classed as a millionaire. If you've got £1 million in the bank, you're a millionaire and you can afford to take the losses. That's how the framework works, even if that's not really true.
Brilliant. Thank you very much for that, David. I think if we have a look at CDS prices now, we of course have seen significant fluctuations of these prices over recent years, notably in the Great Financial Crisis, where these climbed above the 300 mark, and of course more recently during the pandemic, as you can see on the graph there. But more recently, we've seen CDS prices converge towards what is extremely low levels. What are a couple of reasons for this?
Yeah, firstly, CDS is like a measure of risk for the bank. So it's an insurance premium, and a higher price indicates higher risk. And the good thing about CDS, because they're market traded, you can actually get a price for the risk of every single bank, or the larger banks at least. There's a selection of UK ones there on the chart. So it's very much market perceptions. There's not necessarily a huge amount of analysis behind these. Credit ratings would be the opposite. Credit ratings, a lot of analysis, slow to react. CDS, fast to react. But it's not a very big market. It's not like the stock market or the bond market. There aren't thousands of investors trading every day. It's quite a small number of people who buy and sell CDS. So it's the opinions of a relatively small number of people. But, you know, clearly it's driven by events, and looking here at the last 2 years or so, obviously the COVID pandemic's been the key one. So big spike up in March. Another spike sort of September, October, very much due to sort of autumn wave, sort of second wave. A bit less. You might have thought we'd see more of a spike in January, February as the winter wave was sort of clearly coming to mind. But I think people had already sort of taken that into their mindset then. And we had a sharp rise because obviously coronavirus, people are not going to work. You know, lockdown means a lot of people not working. The initial worry was that, therefore, if people aren't working, they'll be unemployed, they can't repay their loans. If the bank doesn't get its interest income and principal repayment of loans, it won't be able to pay back what it's borrowed itself from local authorities and other depositors. So pretty soon we then got the government's rescue schemes, furlough for the unemployed, grants for self-employed, grants for businesses, you know, a huge amount of financial support in the UK government, and similar packages in other governments around the world. And that brought those prices back down again. I guess we worry a bit, have they brought them down too much? You know, are people too relaxed about the risk of bank defaults? I think we have to realise there are a lot of people who are on furlough still whose jobs don't exist anymore. You know, and in a normal scheme, they'd have been made unemployed at various times in the past. You know, different businesses would have made people unemployed at different times. What's happening instead is these people are all on furlough, and the firms are sort of staying alive, paying these people 80% of their original wages, and the government's paying 80% to the firm. That will end soon. Yeah, therefore, you know, those people are probably still paying back their mortgages, or they're relying on the temporary payment holidays that the government aren't twisted the banks to do. So as payment holidays come to an end, as furlough, self-employed support schemes come to an end, you know, we'd expect to see a lot fewer people paying back their mortgages and unsecured loans on time. So I'm sure banks will take the losses. The question really is which banks have got the capacity to absorb those losses, and how big will those losses be? Those are unknowns. So to see CDS levels, you know, back below where they were in the sort of Brexit period is an interesting. Quite interesting. The market's quite so relaxed about it.
Okay, interesting. Thank you very much for that. I mean, you did mention credit updates during that, and we've got a couple of slides on those. So we've got a selection here on this slide. This isn't every single one we've reported this year, but just a few that we've seen during the year. I guess one question I would ask, and probably the first one I would ask, is maybe would you have expected to have seen a couple more, either during the pandemic or sort of in the aftermath of the pandemic, of various financial institutions?
Yeah, it's interesting. There've been relatively few credit rating changes. I suppose that says one of the things to remember about credit ratings is their relative measures of risk. So there will always be people with a AAA credit rating. Okay. And people with a AA credit rating are always going to be a bit less creditworthy than those, and single A a bit less creditworthy. So when the whole market, the whole world moves in one go, coronavirus is pretty much a worldwide event. You don't necessarily expect to see people's relative positions change. So it's always one of the dangers of relying on credit ratings, is that they don't reflect sort of global changes in risk. Clearly, we've seen some changes to the UK rating as a result of Brexit, which will, is expected to affect the UK worse in the short term. Whether it has or not is a bit difficult to say. Obviously, COVID's masked the Brexit effects so far. So, yeah, some of our credit updates on the page. Clearly, some of these are from credit rating agencies. We report significant changes they make. So, Fitch moving Singapore banks to stable outlook. Singapore is one of the few countries, one of the few sort of strong countries in the world where the government still supports the banks. They would expect if there was a bank failure in Singapore, the government would bail out the banks. That's really the only major economy that's true anymore. Canada and Australia were sort of slow to bail in, but they've now adopted it, both to an extent. Of course, the EU and the UK adopted it in 2013. But we're very keen at Ironclad just to not make our credit updates about letting you know what the rating agencies are doing. So we've got a lot of our own analysis here. Some it's sort of news, Transport for London getting a bailout, you know, sort of a factual reporting. But then we've got things like our bail-in updates, our analysis of bank results coming through. So we get people quite a mix of credit updates, so they can get a range of views.
Brilliant, thanks for that, David. And I think sticking with the theme of credit rating agencies, I think it's fair to say they've lost a bit of their squeaky clean reputation, let's say, since the global financial crisis, and people have realised that they are fallible and they can and do make mistakes. But I think maybe if we focus on their speed and their dynamism, and if we have a look at that on the next slide, my question to you would be, you know, are they just too slow when it comes to updates, or maybe is it just because of the holistic sort of process that they undertake? Is that maybe a reason for why they can be quite behind the curve? Yeah,
I think that's a fair point, really, Henry. What we've got in this chart is, so going back to 2020, and the red line is the share prices of a range of UK banks. And the grey line is the CDS price, same UK banks. And obviously around March, we can see CDS prices rising sharply. Obviously risk is increasing because of the pandemic. And we also see share prices falling. It's a bit more gradual, but I think the movement starts at broadly the same point. Share prices are an indicator of credit risk, but they're also an indicator of lots of other things as well. So we sort of use those with caution. Share price really affects the return to shareholders. So if an event happens which increases the risk for shareholders but reduces the risk for depositors, you know, that would see the share price fall. But actually, that's an indicator of improved credit risk for depositors. Whereas something that affects bank profitability overall might be bad for shareholders and bad for depositors and bondholders. So a fall in share price then is a bad news sign. So it's share price movements to be interpreted with caution. But here, you know, the fall was definitely due to COVID and due to risk of people not repaying loans. You know, it was pretty obvious some point in March that things were happening, wasn't it? And we issued our change in advice to clients on, I think it was the 17th of March, advising people to put less into banks, and where they were still going to use banks, to only lend for short periods of time. And you know, for our case, we give every counterparty that we recommend for investment, we recommend a maximum time to invest for. Because obviously, the longer you invest with any counterparty, the more time there is for things to go wrong. Yeah, so, and of course, 23rd of March was when the lockdown was initiated. So, you know, if you're in any doubt that things were going badly, before then, you know, 23rd of March was the key point for the UK, things definitely going wrong. It took Fitch till early April to make any pronouncement. You know, if you only followed credit ratings, you wouldn't know anything was happening till first week in April. And certainly for S&P and Moody's, it was the last week in April before they actually got their heads around doing anything. and S&P and Moody's are thought as to be the sort of the primary rating agencies. They're the sort of the best known, the biggest global agencies. Fitch has got more of a sort of European focus and is less global. But yeah, the rating agencies, they're very methodical. You know, they are quite the opposite of CDS. So you can imagine their sort of junior analyst is in charge of looking after a certain UK bank, and they'll be keeping an eye on the news, but they'll also be reliant on the bank sending them information. You know, I'm sure they have an arrangement with the bank where they get sort of monthly accounts, that sort of stuff fed through. They've probably been sent to work at home. You know, if they think something's up, they mention to their supervisor. He's maybe working at home, he's on different hours. He may be in a different continent, maybe in a different time zone. So these are global agencies with people spread all over the world. They come to a decision, they write a report between them. They send it to a rating committee. The committee, you know, gets a certain number of days before it's called, and the papers are sent round. People discuss it, vote on it. They make the decision. Now, in the EU, credit rating decisions must not be disseminated to the public until the counterparty has a chance to review the report and report back any mistakes. That's if the analyst is based in the EU, and the UK has also adopted European rules. Interestingly, in the US, it's illegal to not issue a credit rating immediately, whereas in the EU, it's illegal to issue it immediately. So a rare example of where things are sort of completely opposite in rules. So that introduced another delay. And finally, I would say they do have a habit of releasing things after close of business on a Friday. Typical modus operandi, these agencies. Partly because they're sort of, well, two of them are American companies anyway, so they do things in the US afternoon. So we often don't get them until Monday morning anyway over here, just to add to the delay. So yeah, I guess some of it's understandable, the delay, but you know, it really does reduce the usefulness of something that's obviously happening in March, isn't reported till the end of April.
Yeah, I think that's a really good point on the sort of global nature of these companies. You know, that's going to slow things down, and then of course working from home is sort of another step in that process and helps to delay it, but they are a useful indicator. And of course there's more liquid measures such as CDS prices we've mentioned and bond prices, let's say, as well. But if we have a think about maybe the credit updates that we mentioned a slide back and think about the local authority market, TfL, of course, recently has hit the headlines, has had a number of bailouts and proposed reforms. Have these bailouts affected the local authority credit sector?
Yeah, possibly. We're showing on this chart the difference between the yields on bonds issued by some local authorities and the government bond yield. And we've got the PLB rate on there on the dotted line. And obviously, PLB now lends at gilts plus 0.8%. So that's your benchmark. Transport for London is the red line. You can see that's certainly spiking up in March. You know, and we've got the GLA and Lancashire's bonds on there as well. I think, I'm sure you can see that on the chart, but they both spiked up at the same sort of time. So yeah, the market was worried that not only are banks going to run out of income, but local authorities are too. Will they be able to repay their debt on time? I guess TfL is a particular case that it's, you know, it's not so much funded by grants and taxes, but it's funded by fee income, you know, bus, train, and underground fares. So, and I guess London, you know, big cities worse affected for travel than the countryside. So, you know, lots of people commuting to London. Normally, most of them stopped commuting, as you and I still are, Henry. Doing it a lot less anyway.
Absolutely.
So yeah, you know, but again, these have come down, and we're now seeing spreads below PLB rates. So we've got the gold line is Lancashire's medium-term bond. There's another 4 years to run that bond. Now trading at gilts plus 50, a significant discount to PLB. Lancashire's long-term bond, a 40-year bond, still trading around gilts plus 60 or 70. And TfL and GLA just sort of very similar to PW rates. So maybe there's bigger issues in London than there are other parts of the country.
Brilliant, thank you for that, David. And I guess following on from that, do you think the sort of TfL bailouts and rescue packages, do you think that potentially sets a precedent for wider government support going forwards if and when it's needed, or would this be an exceptional circumstance?
Very good question, Henry. So there've been a number of bailouts of TfL, and certainly there was a recent rating change. On the agencies put them down by 2 notches. I think Moody's to A3, and one of their reasons was that it gets very short-term bailouts. It gets enough to sort it for a couple of months. It needs to be sorted again. So I think probably most people at local authorities would say the central government is quite short-term in its funding solutions. We've been asking for many years for multi-year settlements for local authority grants. Still I'm getting annual settlements at the minute, which is not too helpful. TfL, not even getting a year's worth of funding, but getting a couple of months at a time. It's not helpful. The first 2 so-called bailouts of TfL really were permission to borrow money. So similar to a capitalisation direction for a local authority. And we did see those for a number of authorities in sort of late March as the financial year came to an end. The biggest of those was Luton, was given permission to borrow some money, and Luton's relatively small authority, but with a very big airport as one of its subsidiaries, and in normal times gets a lot of income from the airport. So they've been very badly affected. But the government hasn't given them any money. It's given them permission to borrow money, charge that to revenue over 20 years through MRP. They've also asked Luton to think about selling the airport. So sort of making interventions. And you've seen this at TfL, they've been requiring changes to the fares structure. The government's put people on the board of TfL. I've not had that with any other local authority where they've installed commissioners due to COVID. But we do get central government installing commissioners at local authorities for other reasons. So huge amounts of financial distress could be a reason for that in future. But yeah, excuse me, it does show that government is generally keen not to bail out local authorities with new cash. It's more about changing management, letting them borrow money, and letting local taxpayers pay it over time instead of having to pay it all up front. More normal forms of government support.
Okay, thank you for that. Before we move on to the last slide, I will just say if there are any questions, there haven't been any yet, but please do use the chat box, which is in the top right hand of the screen. So I guess taking a step back from the local authority market and just focusing on the sovereign, well, we've actually got a slide here quickly on the local authority credit, if you wanted to maybe touch on this, David.
Yeah, sure. These are Close's own proprietary credit ratings, if you like, of local authorities, and we score them as gold, silver and bronze, not because everyone's a winner, but to reflect that even a relatively weak local authority is a relatively strong credit compared to, say, banks and the like. Because local authorities, really, it's very difficult for a local authority to go bust. There's no framework for insolvency at local government, so it's very unlikely to happen. Whereas compared to a bank, there's a definite framework for investors to lose money. But yeah, it's a range. Most people are in the middle, not surprisingly. It's very similar to a normal distribution, isn't it? Yeah. But there are people who are very particularly strong. They're the ones we rate as gold. And there's people who, on the weekend of the local authority spectrum, that we rate as bronze on the left-hand side there. And while there's only 6 authorities with credit ratings from official agencies, we rate all 450 odd authorities. And you can see our ratings are broadly in line with those of the market, those of the rating agencies.
Brilliant, thank you for that. So let's look at the final slide, which is the on the UK sovereign. So the UK local authority market is of course linked to the credit quality of the sovereign, and Fitch most recently, which you can see in the bottom right hand corner of the screen, has upgraded the outlook on the UK sovereign to stable from negative. What will be the impact of this on the local authority market going forward?
Two ways to look at this. My first thought is that it's quite a minimal change. You know, an outlook from stable to stable from negative is obviously an uplift. But local authority credit ratings are intrinsically tied to the sovereign rating. They pretty much go hand in hand, because so much of the local government income comes from central government in the form of grants, basically redistributed business rates according to the formula set by central government. And then council tax is obviously direct from the local population, but even then that is subject to controls by central government, originally capping and now on referendums, which acts as an effective cap. And then there's the extraordinary support, you know, potential bailouts, but more likely, you know, permission to spread costs over 20 years through capitalisation. So the official ratings of local authorities are very much tied to the official rating of the sovereign, and shadow ratings of the type that we produce, the types that potential private sector lenders to local authorities, bond investors use. All of those are sort of kept in mind, what the credit strength of the sovereign is as well. But yeah, I think the clearly we've done well on the vaccination programme compared to a lot of other countries. I think that speaks well for the strength of the NHS in this country, and also the strength of the population in A, accepting vaccines and understanding science, and B, the population, you know, being willing to take an injection even if, you know, they don't think they're going to catch it, but they understand that the more people that are immune from the virus, the less likely it is to spread to everyone else. There's an altruistic aspect to taking vaccines, which I think we're good at in the UK as well. So that all speaks to some of the strengths of the UK. Obviously on the downside, or certainly the downside in the market, you know, the views of Brexit, how that will happen. I still think the market's overplayed the negative impacts of Brexit in the short term. Possibly we'll never know, because you know, COVID has been such a big impact that it's overshadowed anything to do with Brexit. But if we do beat COVID, you know, next year through global vaccination, then maybe we'll see whether there's some lingering overhang from Brexit still. And certainly that's some of the reasons for these downgrades in the UK rating over time. Brexit impact, and we were clearly badly affected by coronavirus to start with. Looking good now.
That all sounds very positive. So we've had two questions come in, so thanks for sending those in. The first one is, what conditions are required for Arning Close to relax its current recommendation on the number of counterparties? Yeah,
so we do keep this under review. We discuss it regularly, and especially there's a range of opinions within the credit group at Arning Close, which is good because it means we can have a robust debate on these issues. I think there's the worry about what happens when furlough ends. That's part of it, and then the risk reward is the other side of this. You know, banks that are paying basically 0% for 6 months deposit, you know, why would you even consider doing it? You know, you may as well have a local authority deposit paying 0.2 for 6 months. You know, someone who can't go bust, and sort of helping your own sector out as well. So that's a big part of that, and we are seeing more and more. It's the larger banks that tend to be the safer ones, and the smaller the bank is, the less safe. So safe for wholesale depositors, that is. Because, you know, the wholesale depositors rank at the bottom of the scale for bail-in, whereas the retail depositors, so individuals and small business, rank at the top. So banks which are mainly funded by individuals and small businesses, you know, are always going to look riskier on our measures, because the local authorities will be in a small section at the bottom of the pile for payout, the top first in the line for bail-in. So I think we're probably more likely to extend our duration advice than we are to significantly increase the list of banks, I think.
Okay.
But it's a committee decision.
Yeah, that's true. Very democratic overall and close. The second question is, can a local lend to a local authority that has an active section 114 notice in place?
So section 114 notices is the I think actually Moody's called it a pre-insolvency notice, which I think is quite a good term for it. And we see it as one of the strengths of local authorities that the system exists. It's where the Director of Finance reports to the councillors that spending is out of control, and it enforces by law a stop on non-essential spending. And then the councillors 21 days to basically set a new budget and to work out what they're going to do to plan. So the section 114 stops local authorities signing new contracts without going through a procedure where they determine that it's in the best interest to do that. So without any sight of that procedure, we feel that local authorities are not allowed to be able to sign new contracts, and that would include new borrowing. Now, maybe you can get a letter from the Director of Finance saying that them borrowing the loan would improve their position rather than worsen it, which is a reasonable impact. It's better to borrow a loan in the local authority market relatively cheaply than it is to borrow it from PLB or to default on your debt. So that could happen, but without that notice, I think you're in danger of lending to them when you're not clear on their legal power to borrow. Generally, the sort of stuff I think clients would avoid. With there's around 100 or so active borrowers in the local authority market. Why would you lend to the one that's in difficulty and not the other 99? I think from a selfish point of view, and it's your money, it's the money of your local taxpayers, you have to be selfish with it to an extent. That's the sort of thing you would consider. So can you do it? We generally advise against it unless we've got proof that the loan is going to benefit the organisation, and it goes through that process that's outlined in the various local government acts. But it's not illegal for you to do so. So if you wish to do so, you can do it at your own risk, certainly.
Great. We've had one more come in. We've actually recently done a Treasury short on these types of investment, but the question's about money market funds. They're of course credit rated and have various credit ratings from the agencies, but how safe are they?
Well, I guess the good thing about the good thing about the money market funds is that they're professionally managed. So, for example, no money market fund had any money in Icelandic banks when they were under, but over 100 local authorities did. You're using people who are active in the market every day rather than relying on your own information there. So you're using people who are much closer to what's going on. People who have the time. It's their full-time job to manage this. Some of them have, and the ones run by large organisations, they have teams, big teams of credit analysts. Up to 100 people working for the whole organisation, deciding who's the good credit and who's not. Something you're never going to get anywhere near the scale of that at your own resources or even using us. So that's why we're very keen on money market funds. But also the fund manager is working in your interests. So when you deal direct with the bank A wants to pay you as least interest as it can get away with, and B, it wants to pretend it's very safe even if it isn't. They're working against you. Whereas a fund manager, it's in their interest to keep your money safe. If they lose your money, that's not very good for them selling their funds to any other investors. And the better interest rate they can pay you, the more fees they can charge, the more likely they are to get business in from elsewhere. So they're very much on your side in the market. It's fund managers of all types. and of course they're widely diversified. If you've got £5 million to put somewhere, you can't easily spread that over 40 different global banks. But put £5 million into one money market fund, they can spread that over 40 very high quality banks across the world. And there are a lot of banks, foreign banks, that are higher quality than UK ones, but they don't really want the odd 200,000 of sterling. They want 50 million of sterling at a time, and that's what you can get through pooling your money with lots of other people in the money market fund. But I think the AAA rating is a bit of a red herring, and that's why we do our own analysis and we publish the average credit rating of the money market fund constituents. We send that out every month. I think that's more of a better measure of the risk of the fund than sort of the wrapper rating of AAA.
Yeah, I think that's a good point about the credit rating, and sometimes it can sort of missignal, if that's the right word, about just maybe how safe they are. Well, that's all the questions we've had today. David, a huge thank you to you for your time and your pearls of wisdom, and thank you, of course, to the listeners for tuning in this week. We hope to see you all next week. Details on that will be released over the next few days, but thanks again to you, David, and thank you to everyone for tuning in this week.
Brilliant. Thanks, Henry. Thanks, everyone. Bye for now.